Today we're going to talk about debt financing, and we're going to talk about debt financing, credit facilities, and understanding the architecture of borrowed capital. Now, we all know, and we have talked about this in a little bit more in detail in other sessions, borrowed capital fuels growth. It bridges financing gaps. It provides financial leverage that can amplify returns for shareholders. And for most companies, debt is not optional. It's an essential component of the capital structure, and understanding how to access structure and manage debt is fundamental. It's fundamental for effective financial leadership. So let me begin by explaining why companies borrow money in the first place. The reasons are varied, but they generally fall into a few categories. Companies borrow. They borrow to fund growth, building facilities, acquiring other businesses, expanding into new markets. They borrow to manage timing mismatches. They borrow to cover expenses while waiting for customer payments or smoothing seasonal fluctuations. They borrow to optimize capital structure, using lower cost debt to reduce the overall cost of capital. And they borrow to maintain the flexibility, having credit available for opportunities or emergencies that may arise. The debt markets offer a remarkably diverse menu of options, and choosing the right instruments for your situation is a critical skill. So let me walk you through the major categories, and starting with the distinction between committed and uncommitted facilities. Now, committed facility is a legally binding agreement in which a lender, it promises to make funds available to you under specified terms. And once a commitment is in place, you have the contractual right to borrow up to the committed amount, provided you meet the conditions in the agreement. And this certainty, it has enormous value. Why? Because you can plan knowing the capital will be there when you need it. On the other hand, you might have an uncommitted facility by contrast, and it's an arrangement where the lender may provide funds, but it's not obligated to do so. And the lender can decline any particular borrowing requests at their discretion. Uncommitted facilities are typically cheaper because the lender is bearing less risk, but they provide less certainty. They're useful for opportunistic borrowing, but should not be relied upon for critical needs. And within this set of committed facilities, the two most common structures are term loans and revolving credit facilities. And understanding the difference between these are very essential. A term loan, it is basically borrowed all at once and repaid over a specified period according to some predetermined amortized schedule. Think of it like a home mortgage, right? You receive the full amount up front, but then you make regular payments of principals and interest until the loan is fully repaid. Term loans are no different. Term loans are appropriate when you have a specific known funding need, an acquisition, a capital project, a refinancing of existing debt. And it comes in several varieties, by the way. And amortizing term loan, it requires a certain principal payment that you have to make throughout, and it steadily reduces the outstanding balance. Very similar to a home mortgage loan. A bullet term loan, on the other hand, it's sometimes called a balloon loan. It requires only interest payments during its term, with the entire principal due at maturity. And many term loans are structured with partial amortization, some principal paid along the way with a larger final payment at maturity. Now, revolving credit facility is a little bit different. It's commonly called a revolver. And how does that work? It's a commitment from the lender that allows you to borrow, repay, and reborrow up to a maximum amount during the commitment period. So think of it like a corporate credit card, right? I mean, that's all it is. You are drawing funds when you need them. You pay them back when you have excess cash, and you draw again if circumstances require. And it is this flexibility makes revolvers invaluable for managing working capital fluctuations and providing a liquidity backstop. Now, most companies of meaningful size, they maintain a revolving credit facility even if they rarely draw on it. Why? Because a revolver is nothing but an insurance policy. Think of it that way. A source of liquidity that can be accessed quickly if unexpected needs arise. You pay a commitment fee on the undrawn portion, which is essentially the insurance premium. And now when you actually borrow, you simply pay the interest on the drawn amount. Okay? So let me discuss the pricing component, because understanding how debt is priced helps you evaluate options, and it also helps you negotiate effectively. Debt pricing has two main components. You have the base rate and you have the spread. And the base rate is a benchmark interest rate that moves with market conditions. Historically, that was often the LIBOR rate. But recall the fact that LIBOR has been phased out. I think the secured overnight financing rate has come forth. It's called the SOFR, SOFR, and it has become the predominant benchmark lately. And these rates, they reflect the general level of short-term interest rates in the economy, and they fluctuate based on the central bank policy and the market conditions. And the spread is the additional interest you pay above the base rate, and it reflects your specific credit risk. So a highly creditworthy company might pay a spread of 1 to 1.5 percentage points above the base rate. So SOFR plus 1.5. But a riskier company might pay 3, 4, or even 5 percentage points greater than the base rate. And the spread is where your credit quality, your industry risk, and your negotiating leverage, they all come into play. Many credit facilities include pricing grids and what the spread adjusts based on your financial performance. So in other words, as your leverage ratio improves, meaning you have less debt relative to your earnings, your spread is decreasing. On the other hand, if your leverage increases, your spread is increasing. This structure, it aligns the interest of borrowers and lenders and rewards companies for maintaining strong credit profiles. Beyond interest, debt facilities typically involve various fees. And those fees constitute arrangement fees or upfront fees that are paid when the facility is established, compensating the lenders for the work of structuring and syndicating the deal. And those commitment fees are paid on undrawn revolver amounts. Administrative agent fees, they go to the bank that handles the ongoing administration of the facility. And these fees, they can be significant and should be factored into your total cost of borrowing. So let me turn to the covenants, and that's important. That's one of the most important and misunderstood aspects of debt agreements. This is where things can go very wrong. Covenants are promises you make to your lenders about how you will operate your business and maintain your financial condition. They are the rules of the road that govern the borrower-lender relationship. And if financial commitments require you to maintain specified financial ratios or metrics, well, you want to maintain that at that point, because you're submitting information to the bank on a monthly or quarterly basis. Common ratios, leverage ratios they look at. They look at debt interest coverage ratio. They look at your trailing 12 months EBITDA or trailing 3 months EBITDA. They look at minimum liquidity requirements, as far as AR or cash in the bank. And these covenants are typically tested quarterly based on your financial statements. Negative covenants also restrict certain activities. They might limit additional borrowing. They might restrict dividend payments. They might prohibit certain asset sales, or they might require you to get lender consent for acquisitions above a specified size. And so these covenants, they protect the lenders by preventing you from taking actions that could impair your ability to repay them. Those are negative covenants. Affirmative covenants, on the other hand, require you to take certain actions, and these typically include providing regular financial statements, maintaining insurance, paying taxes, and complying with the laws and regulations. They ensure that lenders have the information they need and that you're operating responsibly. And why do covenants matter, and why does it matter so much? Because violating a covenant, even a technical violation with no real impact on your ability to repay, it triggers a default under your credit agreement. A default can have severe consequences. Lenders may refuse to allow additional borrowing under a revolver. They may accelerate the debt. They may demand immediate repayment of the entire amount. They might impose penalty interest rates or fees. At a minimum, a default forces very difficult conversations. They might even freeze your assets, and you don't want to be in that situation. It's a very ugly situation to be in. This is why covenant monitoring is so critical. Your finance team must track covenant compliance continuously, and not just at quarter end, but when testing occurs. You need the early warning systems that alert you if you're trending toward a potential violation. And if a violation appears likely, you must act proactively, approaching lenders before a breach occurs in order to negotiate some relief. Lenders are generally more receptive to working with borrowers who come to them early and honestly than those who surprise them with problems at the last moment. Let me discuss refinancing, which is a regular part of debt management. Debt facilities are finite terms, 3 years, 5 years, 7 years. These are common terms, they're common tenors. And as maturity approaches, you must either repay the debt from other sources or refinance it with new borrowing. And even before maturity, you might refinance to take advantage of improved credit markets, to simply adjust the terms of your borrowing, or to align with changes in your business. The timing of refinancing decisions, it involves judgment and market awareness. If you refinance too early, and you may pay prepayment penalties, or you miss out on potential rate improvements. If you wait too long, and you may face unfavorable market conditions that appear desperate, it will weaken your negotiating position. Most CFOs, they begin refinancing discussions 12 to 18 months before maturity to allow adequate time for negotiation and execution. Don't wait. And when refinancing, remember, consider whether your current structure still fits your needs. Well, perhaps your business has grown and you need a larger facility. What happens then? Perhaps your cash flows have become more stable and you can support more leverage. Perhaps you have built relationships with new lenders. And those new lenders should be included in your banking affiliation, your banking group. So refinancing is nothing but an opportunity to optimize, not merely to roll over existing arrangements. I also want to address the nature of the lender relationship because they lend a different dimension of debt management practices. Your lenders, by the way, they are your partners, not adversaries. Their interests sometimes might diverge because they want more protection, they want more flexibility, they want higher pricing, and you want lower, but fundamentally you want the same thing. They want you to succeed because in your success will their sustainability be part of the sustainability. So if you cultivate these relationships actively, you communicate regularly, not just when you need something, you share the good news and the bad news promptly, you invite the lenders to visit your facilities and you meet your management team, help them understand your business and strategy. When lenders have confidence in you and your company, they are more likely than not to provide that favorable terms and to work constructively with you when challenges arise, and they do arise unexpectedly from different sources. And let me offer a strategic perspective on debt financing. The availability and terms of debt fluctuate with market conditions. Credit markets can be remarkably accommodating during good times and remarkably restrictive during downturns. It just goes the other way around. And the time to arrange financing is when you do not need financing. That's a reality. If your results are strong, your outlook is positive, and markets are receptive, and that is when you grab money. I've seen companies struggle during recessions, not because the businesses were fundamentally broken. No, because they had debt maturing at exactly the wrong time and they could not refinance on acceptable terms. Conversely, I've seen companies thrive because they had locked in long-term financing during favorable markets and could focus on operations while competitors, they were scrambling for capital. The CFO who understands the debt markets, they maintain strong lender relationships and they think strategically about the timing and the structure of borrowing. And it creates enormous value. Debt is a powerful tool. And like any powerful tool, it requires a skill and it requires a respect to use effectively. I hope this was very helpful, and this comes from a lot of experience from me. And I've raised about $35 to $40 million in simple debt over $15 to $20 million in revolver facilities. And whether it's a scale, the magnitude is not as important. It's all of the underlying practices that gird the loans taken, the revolvers taken, and we have gone through ups and downs and how you negotiate with the bank. And one thing I've found is that banks truly want you to succeed. They really do. I've not come across any instance where a bank wanted me to fail, ever. Why? Because we were always proactive in providing the information on time in case a bad news would crop up around the corner. The banks were warned ahead. And on the other hand, we always used to share a very detailed analysis every month as part of the report, as part of the covenant reporting that we did. And that created that trust and the friendship and the commonality and the alignment as far as the business relationship was concerned. So treat them as your partners, not just as your bank. Treat them as a strategic asset. And if you do so, then you'll be able to leverage their expertise in the best way possible to advance the interest of your company. So I hope this session was helpful. Feel free to write comments. You might have different points of view. I would love to hear that, and we'll chat later. I hope you're finding this sessions helpful. And if you do, drop me a note. It'll be nice to hear from you. Thanks. Bye-bye.